The Vanguard FTSE All World ETF is the most popular global ETF available in Europe. It's massively diversified, holding more than 3,500 large and mid-sized companies from all around the world. And then there's the Vanguard FTSE All World High Dividend Yield ETF, the most popular dividend ETF in Europe. With over 2,000 dividend-paying companies, it's essentially a subset of the bigger all-world ETF. Any company that pays no dividend, or only a very small one, has been filtered out. But as dividend investors, what we really care about is cash flow. So the key question becomes, which of these two ETFs actually pays more dividends? At first glance, the answer seems obvious: the dividend ETF. Right? Well, not so fast. The regular all-world may have a lower dividend yield, but it comes with something powerful: strong dividend growth. And that can make a huge difference over time. But does it really deliver? Or is that just theory? In this video, we'll calculate how the dividends of both ETFs evolve over the long run. We'll see when, or if, the cash flow from the all-world ETF eventually overtakes the cash flow from the all-world dividend ETF. I think that's a fascinating question, because the answer reveals exactly which ETF is better suited for different investment horizons. Quick disclaimer before we dive in: this is not financial advice, just my own opinions and experiences. Before we dive into the dividend calculations, let's first line up the key facts about these two ETFs so we know exactly what we're dealing with. On the left, we have the regular all-world ETF, and on the right, the all-world dividend ETF. Both are extremely well diversified and backed by massive fund volumes. Vanguard is a rock-solid provider, and if there are ETFs that will still be around in 30 or 40 years, these two are definitely among them. In other words, they're potential forever ETFs. Now, let's look at overall performance since launch. No surprise here, the all-world ETF is way ahead. Since inception, it has performed about twice as well as the dividend version. That's mainly due to how they're built. The all-world ETF has roughly 60% exposure to U.S. companies, while the dividend ETF only has about 40%. In terms of sectors, the all-world is heavily tilted toward tech, which explains its strong total return outperformance. The dividend ETF, on the other hand, carries more weight in financials, less exciting growth, but solid dividend payers. Looking at the top 10 holdings, again, no big surprise. The all-world ETF includes the Magnificent Seven, while the dividend ETF skips tech entirely and instead features well-known, reliable dividend companies. Now, let's talk dividends. The yields shown here are a bit lower than the long-term averages. For the all-world ETF, the average dividend yield since launch is about 2%. For the dividend ETF, it's much higher at 3.5%. That's 75% more. And those are the numbers we're going to use for our calculations. Both ETFs show a very steady cash flow trend. The all-world ETF also delivers impressive dividend growth of around 7% per year. The dividend ETF, unfortunately, only manages about 3% annually since launch, which is quite disappointing. Still, both provide a reliable cash flow, and that's something I personally value a lot. I don't know how it is for you, but for me, stable cash flow is a top priority. There are ETFs I wouldn't buy for this reason alone. Here's one example: the iShares Euro Dividend UCITS ETF. Honestly, what is that supposed to be? If you found this helpful so far, hit like and subscribe. Thanks. To calculate the dividends, I've set up a few assumptions. For our two ETFs, we'll use the following values. For the all-world ETF, a dividend yield of 2%, dividend growth of 7%, and share price growth also at 7%. For the Dividend ETF, a dividend yield of 3.5%, dividend growth of 3.5%, and share price growth again at 3.5%. Now, historically, the dividend growth has been a bit lower, but here we'll still assume 3.5%. Why? Because only if dividends and share price grow at the same pace does the yield remain stable. If dividends grow more slowly than the ETF price, the percentage yield will shrink over time. So, let's invest 100,000 euros into each ETF and see how the dividend payments develop over a period of 40 years. Yes, 40 years is a long time, but it's fascinating to see what happens. Dividends are not reinvested here. They're taken out and spent. That means we're not in the accumulation phase, but in the cash out phase. And to keep things simple, we'll ignore taxes. In short, we invest 100,000 euros and then track how much cash flow this investment generates year after year. For these dividend calculations, I used the dividend calculator from MarketBeat. With the data collected, I created a few charts that I'd like to show you now. And if you're curious about the detailed output from the calculator, I've included it at the very end of the video. All right, let's take a look at how the cash flow of these two ETFs develops over time. In this chart, we see the cash flow for the first 20 years. On the y-axis, you can see the annual dividend payments. What stands out is that the Dividend ETF delivers higher cash flow for the first 18 years before the regular All World ETF finally catches up. But let's zoom out further, because we ran the calculation for a full 40 years. And here it becomes crystal clear. Dividend growth pays off massively in the long run. By year 25, the All World ETF is already paying 2,000 euros more in dividends per year. By year 30, that difference grows to 5,000 euros, and it keeps widening. This chart really shows why it's important to think carefully about whether you want a high-yield dividend ETF or a dividend growth ETF in your portfolio. If you still have a long accumulation phase ahead before living off your cash flow, dividend growth can be the smarter choice. Personally, I use a mix of both strategies, but I give much more weight to dividend growth ETFs. That's just my approach, though. Everyone should decide what fits their own goals. Stronger dividend growth also means your personal dividend yield rises faster. In this chart, you can see how yield on cost would have developed for both ETFs. And there's one more chart I need to show you, because so far I've left out something important. Dividends are great, but we can't forget about the price performance of the ETFs themselves. In this chart, you see how the value of the ETFs would have grown over the years. The All World ETF delivers a brutal outperformance already after the very first year. There's really nothing more to add here. The conclusion is simple. The regular All World ETF overtakes the Dividend ETF in terms of dividends after about 18 years, and it delivers the better total return right from the start. I still love the Dividend ETF, and I do invest in it, but I find its dividend growth disappointingly weak. Who knows? Maybe the future will surprise us. That's it for today. If you're interested in the exact numbers from the calculator, stick around. I'll show the detailed data now.